Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend. Yes, I have friends. Dan Bird, how you doing, sir?
Debatable. I'm good.
Dude, just poke me. I love it. So, man, we've known each other a couple of decades. Something you focus on that I don't, as people have seen in our first two videos, is stocks, more specifically charts. And right here, we're going to talk about the evolution of a trader, because this is something that I got stepped out of and never evolved. So let's talk about it. What do you think?
I'm good.
All right. So where do you want to go first?
Well, first, I've got a few things I want to show, but let's just have a conversation a little bit about trading in general.
Mm-hmm.
You know, on one of the last ones, I talked about three types of traders, investors. You know, there's a gambler, there's a trader, there's an investor.
Correct.
And primarily what I'm talking about here is trader, although it could apply also to investing, because even though investing is a long-term concept, you still want to understand your entries.
Yeah.
The money is made, and it's true with real estate as well, as you know, the money is made when you buy.
Oh, I wish more people got that. Most people think it's when you sell. It's absolutely when you buy.
It's when you buy. And same with stocks.
Yeah. There's a lot of similarities as I've been seeing with stocks, charts, and real estate. It's just it moves at different speeds.
Yeah, that's very true. Yeah.
Very cool.
Yeah, but it's the same idea. So I would say there are three, and I read this in a really good book. I'll maybe on our next time that we meet, I could put together some of the books that I've read.
Please, let's plan for that. Provide
those for people. But this was a guy that started off, didn't know what he was doing, started trading stocks, blew up his portfolio, and lost all his money.
I know what that feels like.
Yeah. In fact, he lost all of his money just before his wedding.
Ouch. That would hurt.
That would hurt. And he made a really interesting point that I thought was pretty accurate. So there's three stages of the evolution of a trader.
Okay.
Stage one is you lose all your money.
That's stage one. Oh no.
That's stage one.
You lose everything. You've proven to be a fool.
And a lot of times people may not recover from that. But it's part of the evolution.
Okay.
And you might do that multiple times.
Oh no.
So I mean, I've read a lot of the best traders out there. They've lost fortunes multiple times.
Oh my goodness. Okay.
But that's the beginning. You bet. There's a lot of reasons for it. A lot of times it's because you're in a raging bull market, so you think you're the smartest person in the room.
I know what that feels like. Yes.
And by the way, if you think you're the smartest person in the room, then you're in the wrong room. You need to find a different room.
I agree with that.
You should not be the smartest. There should be other people you could learn from.
Yeah, you need to up your game. Yeah, I totally agree with that.
Right. So in a raging bull market, everything works. So you don't think about it.
Just real quick, that is my big fear for people who've been trading, working, being paid to sit on the couch, taking their stimmy checks and buying stocks or crypto or whatever. This is the everything rally. This makes me very nervous because, again, my story of investing is I was an investor, straight up investor, read financial statements, did the work, and started winning. Then I became a trader because I thought I was the smartest person and momentum was working. It was a raging bull market in the early 2000s. You could do no wrong, but I didn't know. And then I became the gambler. I stopped doing the work. I just started being stupid.
Yeah.
So the same person.
So usually what happens is you'll start off being an investor, then you become a trader, and then you become a gambler, or you become a trader and nothing works.
Yeah.
And then by default you become an investor.
Gotcha. Okay.
You just sit on it forever.
Yeah, you're diamond hands.
Right. Diamond hand.
I'm not gonna sell at a loss.
That's right.
Again, Cisco Systems. I wish more and more people are going to realize this, right? They're trading GameStop or AMC or some other stupid stock with no future. And I'm going to hold it forever. I bought it 140 and it's at 40. I'm going to hold it till it comes back. Well, Cisco Systems, 14 years.
The most ridiculous thing about that, I mean, all that happened with GameStop, the diamond hands and the Wall Street bets on Reddit and all that stuff. And they have no clue of how the market works.
No, none, zero.
Right? They at that particular time, I had my brother just call me and said, somebody at work told me I should buy AMC. I said, well, do you know the story of the shoeshine boy?
Yeah,
You know the
exactly.
shoeshine?
Oh yeah, John, was it Kennedy? I forget.
Joe
Joe
Kennedy.
Kennedy. Yeah.
Joe Kennedy back in
He
1928.
he got out of the
Getting a
stock market.
shoeshine.
Yep.
The shoeshine boy gave him stock market tips. He goes, if the shoeshine boy is giving me tips,
I'm
then
out.
it's time for me to get out. And he sold everything
It's
and avoided the
saved
crash
his fortune.
completely.
Yep.
So my brother is a server in a very exclusive restaurant in Phoenix.
There you go.
And one of the other, I think it was a busboy or something, is giving him stock recommendations.
Time to get out. Yeah.
Time to get out. Right.
That's funny.
But what happened with GameStop is it was the #1 shorted stock at the time.
Yeah.
Right. So shorting, the way you short a stock is you borrow the shares, you sell first, and you buy later.
Correct.
So your hope is that it's going to go down and you can buy lower, but you're doing it with borrowed shares. So what that means is, especially with margin accounts, you theoretically can borrow more shares than actually exist.
Yeah, I think the 130% of float, they called it.
130% was shorted on GameStop.
That's
all right. And the
right for a short squeeze.
That's right. That's a short squeeze. The folks on Reddit saw this. To their credit, they saw it.
Oh, no, agreed.
Hey, if we just start buying, it's going to force all those big hedge funds to buy along with us, because the only way you can get out of your short is to buy.
Yeah, exactly.
Right? So they're going to have to buy too. And that's exactly. And the stock shot way up, right? Because not only were they buying, but the hedge funds had to buy to get out of the short position so they didn't lose money.
I don't remember which one it was, but it actually ended a Wall Street hedge fund because they got out.
Yes, right. That's right, because they were over leveraged.
Yeah.
All right, but the problem is, and what these hodl people don't understand, is that doesn't last.
No, once it's over, it's over.
GameStop is no longer even on, and I get a report every week of the top shorted stocks. If I ever wanted to play some of them, GameStop's not even on there anymore.
Yeah, it's a hot stove syndrome. Don't touch that one again.
All the diamond hands say, I'm never selling. I am never going to sell because I'm going to force these hedge funds forever to keep buying the stock.
Well, they're out.
They're already out.
They don't got to be in twice.
Not only are they out, the hedge funds saw what was happening when the stock went up to $140 or something.
And they shorted again.
And they shorted.
Exactly.
So the hedge fund shorted there, and they made money on the way down.
Exactly. They shorted into the stupid buying. Exactly.
Right. And all the diamond hands are still holding it.
Yeah.
Wondering what the heck happened.
Good luck. Yeah.
So anyway, there's 3 phases of a trader. There's lose all your money.
Okay.
Stage 1.
Yep.
Stage 2 is stop losing money.
Ah, okay.
Right. Yep. Doesn't mean you make money, but you figured out that maybe you shouldn't be listening to your buddy down the street, buying the stock that he recommends.
Start learning French. Back to our first video.
Maybe you shouldn't have diamond hands.
Yes.
Maybe it shouldn't be hodl. Maybe you should think about getting out when the stock starts going down.
Yeah.
Right. And so
get out early. Leave the door first.
You start figuring out that you need risk management strategy.
Got it. Risk management. Yep.
And I'm gonna show you how I do that here in a second.
Okay.
And then phase 3 is you start making money.
So you lose everything, you stop losing money, and then you finally make some money.
Right.
Gotcha.
Those are the phases of a trader.
I love that. Okay. I like it.
All right. And it's all a learning process. I mean, it's the amount of time you spend in each phase is dependent on how much you're going to learn, or whether you just give up and go sell real estate instead.
I think that's a big, back to your example in video number 1 of learning French. It takes time. This is
right.
It's not easy. There are lots of variables and endless activities. So yeah, I think that's a great example.
That's right. So the most important thing of getting to stage 2 and then finally getting to stage 3 is risk management.
Got it.
That is number 1. And what risk management means to me is position sizing. How many shares should I buy? So if you, and I don't know if this relates to you or not, but I'll just pick on you and use it as an example.
Pick on me.
Let's say you were buying Cisco and you thought you were the smartest guy in the room and you couldn't do any wrong because you're in a raging bull market, and you said, I'm going all in. I've got,
pick a number, whatever.
$10,000, $20,000. I'm going to put it all on Cisco. Put it all in black.
Yep.
And then Cisco crashes. Guess what? You're in stage 1 trader.
Yeah, of course.
You lost all your money.
I did.
That is absolutely the wrong thing to do. You need to have risk management, even if you're in a raging bull market.
Yeah. Even if you are convinced, beyond convinced, you need.
Even if you're beyond convinced, even if you think you should mortgage your house and leverage yourself and go on margin, which is what a lot of people did as well, went on margin to buy all these stocks.
Oh, yes.
Because you're that sure that Cisco was going
the next
to the moon.
thing. Yeah, the moon.
You still need to have risk management strategies.
Agreed.
I'm going to share my screen.
Okay.
And I'm going to show you.
I have a similar chart for real estate. Other graph.
This is my risk calculator.
Oh, I like it. Okay. All right. Let me absorb this.
All right. So I'll step you through it, but it's basically set up so you can have 3 different portfolios. I have an imaginary 100,000 in each of these.
All right.
It could be any number you want. So let's say we pick a stock like NVIDIA.
Gotcha.
I can put NVIDIA up here. I can click on this, and it brings up a chart of NVIDIA, so I can see what NVIDIA is doing right now. One of the things that I want to look at is something called the ATR. See right here, ATR. That's the average true range.
Oh, okay.
So that's the average range that NVIDIA trades in every day. So NVIDIA trades in a range of about $16. That's pretty volatile.
Interesting.
So that's one of the things that I want to know. I also want to look at the chart and see what it looks like.
So that's just so we're clear in a range, that's the min max of the price, the highest price of the day and the lowest price is a $16 range.
Correct. That's
okay.
Exactly right.
All right.
All right. So that's the ATR for NVIDIA.
All right.
So I put that right here, $16.
Okay.
So now what I'm doing here is I'm trying to figure out, all right, I want to buy NVIDIA. I have $100,000 in my account. How many shares can I safely buy based on my risk management strategies?
Okay.
All right. So the first risk category or parameter is a trading rule. And I've actually I can actually send this risk calculator to people if they want to sign up for my newsletter.
Yep.
And I'll post how to do that in a minute. But
okay.
So this is the trading rule. I never want to risk more than 1% of my whole account on one trade.
On a single trade. Got it.
On a single trade.
Okay.
So that's $1,000 is the most I can risk.
All right.
All right.
I like it.
Step 2 is an account rule. I never want to risk more than 10% of my whole portfolio, 100,000, on any one trade. So that's $10,000. What that means is I cannot have more than 10 trades going at once.
Oh, I got you. Okay. Now I got the difference. So it's not 10, it's not like you're buying NVIDIA 10 times, it's 10 total trades.
Yeah, I'll show you how I get to the number of shares to buy here in a second.
I'm with you now. Okay.
All right. And then the final one is the volatility rule. How volatile is the stock? Now, $16 in a day is pretty volatile.
Okay.
But, it's trading at $300. So
2%.
So I have a parameter of 0.75 to 1%. That's the recommended that I use for this.
Okay.
And that will identify the volatility. All right. And then this is my exit rule. I can use this to exit 2 times the ATR.
Got it.
Basically. Remember the ATR was 16?
So 32. Okay.
Actually, 16 here. Right. So 2 times that is 32. So if it's at $302, then I shouldn't keep it if it goes below 270.
Got it. Okay. All right. So you mind times 2. Okay. Got it. Yep.
Right. All right. So these are the 3 parameters: trade rule, account rule, and a volatility. All right. The next thing is I put in what my stop will be. I usually use a percentage because I need to know that to figure out how many shares to buy.
So every time you're doing a buy, you also are calculating your stop. So you're setting your max risk, max loss.
Right in the beginning. That's what takes the emotion.
Oh, I wish I had this. I wish I did this 20 years ago.
Yeah. That's what takes the emotion out of it. So 7% is the recommendation from IBD, Investors Business Daily.
Oh, interesting. I didn't know that.
Right.
Okay.
So 7% there. So if I were to buy this and
so you buy it at 300, your max loss to be $21.
Selling for. So it's selling for 303 right now.
Yeah. So if we assume 300, 7%, that's 21.
24.
Yeah. Okay. Got it.
Right.
Okay.
So I put the price in here. So 303.21. All right, 7%. So my stop price would be 284.
Perfect. Makes total sense.
Well, you follow?
Yeah, I do. Yeah, absolutely.
Now I have to do this. I cannot place a trade
without a stop
unless I go through this exercise.
Nice.
I can't.
Okay.
And I can't go through the exercise unless I know what price I will get out at.
I love that. That one thing is almost nobody does. And I certainly didn't do it 20 years ago.
Well, professional traders do.
Again, not many people do it. There's a lot more people trading stocks than professional traders.
Right.
Yeah, folks, I will ask you, do you have a stop loss on any of your stocks today?
And my stop loss goes in immediately as soon as I execute the trade.
So you buy the stock, stop loss is next. I like it.
Right.
Okay.
So now what I can do here is on the other side is if I want to put an actual price in instead of a percentage, I can do that too.
Of course.
So remember the ATR on this, the 2x exit rule was 364.49. Or actually it's 271.22 and I actually put it right in here. Okay. So that's the 2 ATR.
Yep.
271.21. So if I wanted to use that instead of 284,
right,
I could, but now I've got an 11% loss instead of a 7% loss.
Got it.
Now it just depends on if I want to risk that much or not.
So this again is a choice.
It's a choice. Right, the choice. Do I want to use a percentage? Do I want to use an actual price? And that goes back to looking at the chart and identifying support levels. You know, where do I think it's going to go down to?
Yeah, and the delta is about $12 or $13, I guess.
Right. I mean, you can see here, you know, there's 280, so it's come down to 280 or 275 basically.
Okay.
And then went back up. So that's support. So roughly about 275. Is where support is, and this one here puts it at 271.
Interesting.
So if I want to risk 11% instead of 7%,
yeah,
that's probably a pretty good level.
But these again are choices you're making before you put in the
choice that I make before I make the trade.
Got it.
Because
before you buy.
Remember, as soon as I execute a buy, I will immediately be putting in a stop loss.
I love that.
It will be automatic.
I wish more people did that. I wish I did.
All right.
Okay.
So it will either be 271 or 284, depending on how I feel about the stock and the market and everything else.
Okay.
The 284 is a little bit more conservative, but this is the 2R.
I'm in. Right. I'm with you. I like that.
All right. So then the next section down here will tell me how many shares I can buy.
Interesting.
So I can't go crazy and buy 1,000 shares.
Okay.
Because what this does, it uses these 3 rules up here. It calculates the amount for each of these, and then it uses the lowest one.
I like it because originally I was looking at $1,000 going, damn, you're going to buy 3 shares. But now I understand because you put in a floor, you're calculating your max loss against that. I get it. I understand.
Right. Exactly.
I got it.
So this is called position sizing. This is the most important thing for risk management, is knowing how many shares you should buy.
Yeah.
Now, if I sort of reverse engineer this a little bit, it'll be, just back of the napkin stuff. But this one here says 10%, so I can't buy more than 10. But if I'm buying 30, that theoretically means I can buy, if I wanted to max out my whole portfolio, I could buy 300 shares.
Okay.
But I don't. But I don't want to max out I want a risk management.
Yeah, exactly. Yep.
Now, notice what happens over here when I put the actual number in, which was 11% risk instead of 7%. That's fine. I can use that number, but now I can only buy 20 shares.
Interesting, because the other rules jump in because your loss can be larger.
That's right. So it's taking the lowest. It's calculating out the lowest one.
So again, you could give yourself more risk, but given the larger risk, your portfolio size or your what'd you call it? Position size has to be less.
That's right.
I like it.
It actually keeps the risk the same.
Yeah, because if you bought 30 with the higher risk, then you invalidate one of the earlier rules.
That's right.
Ah,
exactly.
Look at you, how clever you are.
All right. So so I do this. So I do this every time before I place a trade. So now I know I can buy, if I'm going to place a 7% stop, I know I can buy 30. So what this is doing is it's setting everything up for me. I don't have to think about anything.
Non-emotional. It's almost robotic.
That's right. Non-emotional. I mean, you could theoretically program this. Which
That'd be no fun.
All the hedge funds already have.
I'm sure, yeah.
All right. So now I know that my stop order will be at 306. Oh, that's a buy stop order.
Okay.
Yeah, this is something a little different. If this is using this 1% right here, recommended. Right. So if I say, I think this is going to do well, but I want it to prove itself first. I want it to go up 1% before I buy it.
Right.
Right. So then I'd be buying at 306.
Okay. Instead. That makes sense.
So if I don't care about that, if I just want to buy it right now, I just make that 0. And now it's at 303.21. And now you see it's 30.30 on both of them.
Interesting. Okay.
All right. So now I can buy 30 shares.
Got it.
So then if I want to stage my entries, half a position is 15 shares.
Ah, interesting.
And then I can do this, the next one at a 2% move. When the price goes up 2% to 309, I buy another 9 shares. And then when it goes up another 1% to 312.
So you're basically what you're doing this, you're setting max trades, but you're also not getting in at one time.
Correct. So
you're validating so you're validating the reason why you're buying.
It prove to me that it's going up.
Look at you.
I have no tolerance for stocks that go down.
So again, so you buy 15, let's say the stock goes the opposite direction. You haven't lost because you didn't buy all 30. You've only lost a portion of that.
That's right.
Ah, look at you.
If my thesis for the stock was wrong,
you've only risked half the purchase.
I've only risked half of it. And if I look at the chart right here, it looks like it's bounced right here and looks like it wants to go higher.
Interesting.
So it's probably going to keep going up, maybe back to the high at 340.
Interesting.
But it needs to prove to me that it's doing that.
Okay. That's
if for some reason my thesis ends up being wrong, and remember I use charts to figure out the direction. I'm not just doing this blind.
No, of course. Yeah, right. Go watch video 1 and video 2, folks, from today's conversation. Right. Yeah.
So now I know I can buy 30, I buy 15, I buy 9, I buy 6.
Again, this is something I freely admit I wasn't doing 20 years ago. If I wanted to buy 30 shares at something, I'd buy 30 shares.
Right. Yeah.
I didn't tranche.
And then this is my exit. If I wanted to exit at 328. And
so do you put that on right away as well? I know you put it right away.
I do not put the exit on right away. No.
Okay. All right.
So you can see 328 is right up about right here.
Yep.
Which is right in the middle of this resistance level. So that's probably a pretty good exit.
Okay.
But if I wanted to wait, I could.
Right. But you do put the stop on.
I do put the stop on right away.
Got it.
Okay. But the exit, this is just so I can watch it.
Yeah.
And if it gets to 328, then I make 8.5%.
All right. I got it.
And if it does that in a week or 2 weeks, then I make 8.5% in 2 weeks.
Yeah. Then you times that by 26 or whatever, and you get your yearly return. I like it.
Which, by the way, is another thing that a lot of people don't do. They buy the stock just thinking it's going to go up forever.
Yeah.
Right.
Trees don't go up to the sky. Yeah.
Right. What I typically will do, and that's not really in here, but what I will usually do if it does prove itself, let's say it's going through all these levels, then I will move the stop up. To below,
you'll
below the 21-day moving average.
Got it. Now, when you choose to sell, do you sell all at once?
I usually sell all at once.
So you buy in tranches, but if it goes against you, or you want out because you made your profit.
If it hits my stop, I'm selling all at once for sure.
Got it. Okay.
But usually, if it hits my profit, or if it hits a resistance level, or the chart shows that it's starting to move down, then
you're all at once. That makes sense.
Each of these has a little explanation of what they mean.
Cool. All right, I like it.
And you can do 3 different portfolios if you wanted to.
Yeah.
I just use an imaginary 100,000 in each one.
Yeah.
I'm actually going to try to set this last one up for trading options. And that's a different conversation.
Yeah, most people should not be trading options, in my opinion.
Most people should not trade options, but there is a fairly safe way to do it.
Yeah, we are not going to be talking about that on this channel. I don't want anybody to get smoked in options.
Yeah. All right. Yeah, that's different.
That's a different.
All right. So this is risk management. This is the number one most important thing to do.
And I would ask everybody watching this right now, what is your risk management strategy? I will tell you what my risk management strategy was 20 years ago. I didn't have one. I didn't think about one. I didn't even know when one was. Percentage of account, how much you want to put at risk, stop losses, buying in tranches, just all of these things that I'm so scared. There's people watching YouTube creators now who are making millions of dollars a month buying on whims and all these things. They're not talking about these strategies and protecting yourself and controlling the downside, right? It's always about controlling the downside, let the upside take care of itself. I love this conversation. Thank you.
It also illustrates that the money is made when you buy.
Yes.
Right?
Yeah. And you're protecting the losses, right?
You're protecting your portfolio. You're protecting yourself from going back to stage one.
Losing everything.
Right. Or even stage two for that matter. But at a minimum, it will keep you at stage two.
Yeah. Very, very cool. Dan, can you stop sharing for a sec? Just wrap this up for folks.
You bet.
So folks, what I plan to do here, again, one of the things you'll know about me is I only talk about what I know, and I go find friends or other experts for stuff I don't know. And stocks, charts are one of those. So Dan has graciously agreed to come on every Saturday morning right after my live stream with my students. Also, something I'm going to do is I'm going to go ahead and move some money into Charles Schwab, probably 20 grand or so. And we're gonna see how I do looking at charts with guidance. So it's going to be a lot of fun.
Hey Mike, can I share my newsletter?
Yeah, please. Oh, yes, please. Yes.
Just in case nobody saw the first one.
Yeah, they're going to want to see this because folks, you're going to want to be on the newsletter.
Just send me a note with your email to breakpointtrading@gmail.com, and I'll put you on the distribution list. There's no charge for it. It's something I do every Saturday. This is an example of last week's when I talked about the Santa Claus rally, and I usually put a couple of cute cartoons in there each week. And I start off by showing what the market's doing.
Very cool. Look like. Breakpointtrading@gmail.com, just in case you are listening on the podcast. Breakpointtrading@gmail.com. Dan, thank you very much for doing this. We will be talking every Saturday.
Sounds good. Thanks.
Thanks, buddy.